All right, everybody. Today I'm going to be talking about a stock I'm involved in. So I want to start with a disclosure. I'm an associated member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All trades placed by me, Derrick Goldsmith, are through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. And I need to follow that up with a position disclosure. So these are the positions that I'm currently in. The one that I'm going to be highlighting today, the one that I'm going to be talking about, giving you some background on, is this WE right here. I am currently in a position in WE, so I want to make sure everyone's aware of that. All right. So again, my name is Derrick Goldsmith. I am senior trader here at T3 Trading Group. I've been trading professionally with the firm for over a decade. I also manage a group of traders for T3. And one of the positions I want to talk about today is WeWork. This has definitely been a big story in the media for quite some time. And as of yesterday, they changed symbols. So they had a merger with bowx, B-O-W-X was the symbol, which is a SPAC, which stands for Special Purpose Acquisition Company. It's basically a blank check company. So they had a deal, a merger with bowx, and now WeWork is a publicly traded company. All right, so let's talk about this a little bit. Let's go back here a little bit and look at the chart. So most of what we're seeing here on this chart was the stock as the symbol BOWX, bowx. SPACs, we know, were a really big thing into the end of 2020 and beginning of 2021. So much so that it was a little ridiculous. I was telling everybody in the VTF, the Pro Desk Virtual Trading Floor that I run, there were so many SPACs that went public at the end of last year and the beginning of this year that I almost viewed it as problematic. There were more SPACs that I felt there were good companies out there that they could possibly merge with. Not to mention the fact that most companies, going SPAC is not the only way that you can go public, right? Most companies who go public, they go through a traditional IPO, initial public offering. Others now, like what Spotify had done, do what's called a direct listing. But a third way that a company can go public, which we've seen a lot of this year, is through a SPAC, which some people refer to as SPACing. So the thing about a SPAC, a special purpose acquisition company, is that, like I said before, it's basically a blank check company. So they're sitting on cash. And what they want to be able to do is merge that with a company who needs that cash and who is also looking to go public without taking a traditional IPO. So, some big SPACs that we saw this year, like an example would be DKNG. DKNG was a big one. Or NKLA, Nikola. This was one of the early SPACs here in 2020 when the craze was just kind of coming together. So again, it's a way for a company to be able to go public, raise cash at the same time, but not necessarily have to go through the traditional IPO process. We saw a ton of SPACs go online at the end of last year, the beginning of this year. I personally felt that it was a little mini bubble. We did see in the market as a whole, you'll find many stocks hit their year highs, their all-time highs last February, even though the S&P and the NASDAQ have continued to go up. Many stocks that were speculative stocks, like the Palantirs of the world, actually hit a big peak in February, and that was about the same time that the SPAC craze was really going on. So basically a SPAC, once it goes public, has 1 year to find a company to merge with. If they don't find a company to merge with within that year, they then return the cash to the shareholders of the SPAC. So the cash value of a SPAC is $10. If you invest in a SPAC and it doesn't get a deal done, you're going to get your $10 back less some fees. So obviously the idea here, everyone is incentivized for the SPAC to try to get a deal done with a good company. And then there's another major portion of a SPAC deal where there's additional financing that comes through the form of a PIPE. PIPE stands for private investment in public equity. So in order for a SPAC to really go public, not only do they need the SPAC merger to occur, but they really need the PIPE funding to come together as well. So with all that background in mind, let's talk a little bit about the WeWork story. So WeWork, back in 2019, had a failed IPO. It's kind of crazy. I think I've only ever seen that happen a couple of times in the history of my decade-plus professional trading career. But this company had so many problems. They had a terrible CEO, Adam Neumann. They had a terrible upside-down cost structure. They were just bleeding money out the ears. It was kind of insane. And I remember telling my team when WeWork was trying to go public back in 2019 how much I couldn't wait to short it. It was trying to go public at a valuation of somewhere between like $47 billion and $57 billion. And all I could do was tell my team every day, man, I really hope that this WeWork makes it out as an IPO so I can short this thing to zero. I wanted to short WeWork so bad. I was talking about it almost on a daily basis. The valuation at $50 billion was absurd. The company had terrible leadership, and to make it to add on to that, they were losing billions and billions of dollars pretty much every quarter. So the IPO didn't happen. It was a failed IPO. SoftBank had to come in and kind of bail them out. They got rid of Adam Neumann, the worst CEO ever, and that seemed like the end of the story. Then COVID hits. Okay, we all know what happened with the market during COVID. The big drop, the subsequent rally, pretty crazy price action in 2020, a lot of opportunity for us. Then at the end of 2020, the speculative bubble starts to come in for a lot of those, again, Palantir type names. I just used that one as an example, but there's dozens that we can point to. At the same time, the SPAC craze comes together, and finally this bowx goes public as a SPAC and really gets some interest here in March. I believe it was on March 26th that bowx announced that they were looking to do a merger with WeWork. I thought that was pretty interesting. So on that day, WeWork, which was bowx, ripped from a low of $10.13 to a high of $12.10, and then within a week had put in a high of $13.93. So basically $14 is our big resistance level for WeWork, which again was bowx. I was actually really intrigued in that. I bought bowx as a SPAC on that day when it was announced on March 26th. I got a really good price. I don't remember exactly what my price was, but I think it was about $10.20. And I participated in this run, and I participated also in the subsequent pullback to $10. I gave some of my position all the way back to $10. Sold some on the way up, bought some of that back on the way down, but long story short, I held that all the way back to $10. And this sell-off in June and July, as this thing worked its way back down to 10, was partly due to the fact that SPACs, which were so in favor at the end of last year and the beginning of this year, the opposite happened. The market realized what I was talking about at the beginning of this year, which is that there were just way too many SPACs. So they began to really punish them. And, it's really interesting in markets how the pendulum of information can kind of swing back and forth on, what's in favor and what's not in favor. How, when the market goes to a bubble, it can swing all the way to one side. And then when that bubble bursts, it's very easy for it to go all the way to the other side. Because now in the last couple of months, what we've seen here is most SPACs can't really get their mergers off the ground. And again, that has to do with the fact that a lot of the companies that exist, they're just not great companies. No one wants to merge with a company where the value of that company is worth less than the cash of the SPAC. We've seen some examples of that as well. Some disaster SPACs that got off the ground, earlier in the year when it was still popular. Like an example is this LOTZ, LOTZ. This was a SPAC at the end of last year when SPACs were really hot. It merged with LOTZ, which is like a used car company, LOTZ. It initially gave a rip up to, almost $13 over the course of a month or so, back when SPACs were really hot. And then people started to realize, well, maybe this isn't the best company in the world, and you can see that this thing is slowly bled out to $3.50. I kind of think, and I don't know LOTZ here, car lots business really well, but I kind of think that this business that the SPAC wouldn't even have been able to take place if they were trying to do that now, because the pendulum that I'm talking about, it was all the way over here where the SPACs were so hot, and now it became all the way over here, and that's what brought the WeWork SPAC all the way back down to $10, is that the market got so negative on SPACs because they saw bad deals coming out, they saw them bleeding lower, that now that pendulum, I think, has started to right itself again, and we're seeing many less SPACs be able to get off the ground. I think there was only a couple in the entirety of the month of September, and they're actually now performing in general much better again. Like this GWH was a SPAC, and you can see here that the first day, I don't have historical data on when it was a SPAC, but when it switched over to an actual company, which is this GWH, you can see on the first day it was trading below $9, but by the second day it had ripped all the way up to almost 29. So, going back to our WeWork story here, what changed? Because something changed, I think, really fundamentally about WeWork that got me excited to be involved in this. Remember, I had just said that back in 2019, this is the company that I wanted to short to zero. Terrible CEO, terrible management, terrible business, bleeding money. What happened? Well, a couple of things. First of all, COVID happened. I really think that COVID entirely changed the landscape for office space and for companies, and they did it in such a way that is potentially really beneficial to WeWork. What a lot of major companies are realizing right now is that they don't have to have the same amount of office space that they used to have. Companies are seeing that they're actually getting a lot of efficiencies from their employees being remote, but they realize that there are also efficiencies by bringing their employees into an office where people can see each other face to face and communicate. Companies want the best of both worlds, and this is what a lot of employers want as well. Employees want as well. There's been the chatter of like the great resignation of a lot of people all quitting their jobs all at once who work kind of desk jobs because they don't want to return to an office. Well, a company like WeWork potentially offers corporations the best of both worlds. You let people be able to work a lot of their time at home. You don't have to pay for a full lease on a major office space yourself, but you can still bring people together for periods of time to get the efficiencies of being in the office. I think that for a lot of companies out there and for a lot of employees out there, this is really a perfect mix of both. So from the qualitative fundamental perspective, which is one of the things you guys hear me talk about all the time, I see that WeWork is in a better position than I think it's ever been in. At the same time, they overhauled their management structure. Adam Newman is out, and there were a lot of legacy costs that they had to get through as a result of that. The new CEO that they brought in, I forget his name off the top of my head, but he has a background in, first of all, in turning around companies, and he has a major real estate background, I think, at Brookfield. So he's got the pedigree to be able to take a company like WeWork and bring it to the next level. What has he done? He has really focused on that backwards cost structure that WeWork used to have. He refinanced a lot of the leases that they have. He got rid of a lot of the bad leases that they had entirely, and now WeWork, I think, is much better positioned as a company to be able to come together. At the same time as we get rid of the bad management, we change around the cost structure, we also bring down the valuation. This thing was trying to go public at like a $50 billion valuation in 2019, and I believe it went public via the SPAC at a price of $10 with a valuation of about $9 billion. That's a huge discount from where it initially was. And then obviously you got some big players involved in this, SoftBank being, one of the major shareholders. I'm pretty sure that, the public information out there is that they made a huge investment in WeWork at a price equivalent of basically $19, even right now as we're trading at 13. So SoftBank is still underwater on this thing. But basically all of these things kind of came together, all of these qualitative fundamentals. And by the way, WeWork is one of the best examples of a company that should use this SPAC to go public. And the reason for that is the IPO was such a disaster for them. It was a PR nightmare. I mean, there are documentaries that are made about how bad WeWork was and how bad it was that when they tried to go public, how terrible the CEO was. I think many of us have seen those documentaries. So SPACing for WeWork it's perfect. This is like the ideal company to use a SPAC to go public. So for me personally, coming into the SPAC, I have a tremendous amount of conviction in this as a trade for myself, that it's worth more than the valuation in which it is SPACing at, based on all the information that I already provided to you guys. So what did we see? Tuesday of this week, the vote happened. And I believe that was, what's today, Friday? So that was here. And so the vote passes. This is still bowx, so there's a vote for all the shareholders of the SPAC to become WeWork. The vote passes. The stock immediately has a big downtick on it to $8.85. But this is a very typical pattern that we've seen with many stocks as they SPAC right before they switch over to the symbol. Just a perfect recent example, again, is this GWH. What you can't see here, because I don't have the historical data of the SPAC, is that in the last day this was trading on the SPAC symbol, it went to a low of about $7.20. So they hit that even harder than they hit WeWork as soon as the vote passed. But once this changed symbols, within 2 days, it was able to give this run up to almost 29 bucks. We go back to WeWork here. Well, they smashed this WeWork down in very typical SPAC pattern. As soon as the vote passed, they probably shook out a whole bunch of people who were long listing in $10 who couldn't afford this price decrease. By the next day, it's back above 10 bucks. And then yesterday was the first day that it was trading under the new symbol WE. So yesterday it opened up at about it opened up at $11.28, and it closed at $11.78. So a little bit of a price increase there. Had a quick dip that got bought back up, but it closed pretty well. It closed near its high, so that's a good setup. I do think that some of the wind was taken out of the sails of WeWork because we saw this insanity yesterday with DWAC. DWAC also, by the way, is a SPAC. The plan here, I don't really want to talk about this one too much, but the plan here is for this DWAC to potentially become like the Trump media organization, and this thing went completely insane. It was up like 500% at highs yesterday, giving a move from $10 to over $50, and then today we saw a high of 175. Just completely nuts when that news dropped. And I actually think that took some of the wind out of the sails of WeWork's SPACing yesterday. But even with that, it gave a good move, a good close, gapped up again this morning, traded higher pre-market to gap up again this morning, gave a quick uptick to 15 bucks, and now is pulled back to around $13.15. For me personally, I've sold around 25% of my position so far into this up move, so I still do have a really solid core position. Again, I've been talking about this one for days into the Pro Desk virtual trading floor, that I really was building this position and adding heavily at $10 prior to WeWork, bowx switching over to WeWork, because I was looking for this pop to come in on the symbol change. But even with that, we really just hit my first target today. So my first target for WeWork is $15. That's why I've sold about 25% of my position into this move. My big picture target, if it can really make it to this, my reach target, if you will, is 25. So we'll see how this thing plays out. We'll see how it closes today. So far, the trading in, I think, is decent, but I'm looking for further follow through, and we'll see if I'm right. I just want to reemphasize, though, just because I'm in this position is not necessarily a recommendation for anyone else to get involved. I'm just providing this for informational purposes. Even though I am bullish on the position, you have to assess the risk for yourself, especially if you're getting in at this price. For me personally, I think I'm in a game plan now where I'm kind of in a win-win situation, where even if this thing, if my idea is totally wrong, which could happen, I'm probably not really going to lose anything on this. But if my idea is able to really work out and it hits my second target or my reach target, then hopefully this becomes a big payday for me. All right, everybody. So if you liked this video on WeWork today where we did this analysis, I can definitely do more of these. So tell me that you like it in the comments. Give me a like. Give me a subscribe. Check out the links in the description where you can learn about how you can become a member of the Pro Desk virtual trading floor that I'm managing, or about how you can become a professional trader with T3 Trading Group yourself. I'll catch everybody next time.